Welcome to This Explainer. Today, we're putting on our financial detective hats and digging right into the latest SEC Form 10Q filing. We're going to see exactly how a niche market leader builds, scales, and defends its entire empire. So let's just dive straight in and uncover the numbers behind the landscaping giant SiteOne Landscape Supply. To really get a handle on their operation, here's our roadmap for today. First, we'll meet SiteOne. Then, we'll check out their financial scorecard, followed by their growth engine, which is acquisitions. After that, we'll look at capital and equity. And finally, we'll look ahead at some key risks.
All right, part 1. Meet SiteOne.
You know, SiteOne Landscape Supply isn't just your friendly local mom-and-pop shop. We are talking about a wholesale distribution powerhouse here. They're operating over 680 branches, catering exclusively to green industry professionals all across North America. Think of them as the absolutely vital supply pipeline for everything from concrete pavers to complex irrigation systems. It's a massive footprint.
Moving on to part 2, the financial scorecard.
So let's look at the numbers. When we compare the 3 months ending in June 2025 to that same period in 2026, the growth is just undeniable. Net sales jumped from just over $1.46 billion to a really impressive $1.53 billion. And that bumped their gross profit up from $531.4 million to $564.5 million. Ultimately, their net income steadily rose from $132.1 million up to $139.3 million. Bottom line, they're moving way more product and, crucially, keeping more profit. Now, breaking down that huge $1.53 billion figure, it's pretty clear right away that traditional landscaping products, things like hardscapes, nursery goods, outdoor lighting, those make up the vast majority of their sales. That specific slice of the pie pulled in nearly $1.2 billion this quarter alone, completely dwarfing the $343 million brought in by agronomic products, which is stuff like fertilizer and seed. But, as any good financial detective will tell you, context is everything, right? Much like the natural life cycle of the landscaping industry itself, SiteOne's business is incredibly seasonal. Because they rely on good weather for outdoor work, we can reliably expect these peak financial harvests to happen mainly in the second and third quarters of their fiscal year. What that means is their cash flow is highly concentrated in those warmer summer months, which totally dictates how they have to carefully budget and manage their spending when things freeze over in the slower winter season.
Let's turn to part 3, growth engine acquisitions.
Okay, you've got to see this number. In just the first 6 months of 2026, SiteOne deployed a massive $76.1 million purely for buying up other companies. And to put that into perspective for you, during that exact same period the prior year, they only spent about $11.4 million. So yeah, they have significantly accelerated their buying spree to just gobble up more of the market. This builds a really continuous timeline of expansion. Their purchases aren't random. They are relentless and highly calculated. If we move chronologically, we see them grabbing Pacific Nurseries in early 2025, then French Broad Stone Yards later that year. Come January 2026, they snagged Bourget Flagstone in California, and then they made a massive play for Reinders in its 12 Midwest locations in March 2026. So, what's the key takeaway here? It's their dual-pronged growth approach. On the one hand, they're buying up these multi-state distributors, like Reinders, to rapidly expand their geographic footprint. But on the other hand, they're also picking up hyper-local, single-location specialists like Bourget Flagstone, so they can instantly dominate very specific regional niches. Honestly, it's a textbook roll-up strategy, and it is working.
All right, section 4, capital and equity.
So, way back in late 2022, the board of directors authorized a colossal $400 million share repurchase program. Now, this is a massive flex of capital deployment. It basically means the company is setting aside a giant pile of cash just to buy its own stock back from the public market. And they are absolutely actively using it. In the first half of 2026 alone, they bought back nearly 1 million shares at an average price of about $119 each. This signals incredibly strong internal confidence from the management team, right? They clearly believe their own stock is a fantastic investment. And the crazy part is, even after all that buying, they still have a solid $105 million left in the war chest for future buybacks. Now here is where things get really strategic. To understand their next move, we need a quick definition of a finance term: redeemable, non-controlling interest.
Simply put, this is a minority ownership stake in a subsidiary company that the parent company can either be forced to or chooses to buy back. We actually see SiteOne using their stock as a strategic weapon to gain total control here. Effective June 1st, 2026, minority partners in a subsidiary called Devil Mountain Nursery exercised their right to sell their remaining 25% stake. But get this, SiteOne didn't just drain their cash reserves to pay the $26.5 million price tag. Nope, instead, they smoothly utilized about 217,000 shares of their own treasury stock to take 100% ownership. It is a brilliant move. It preserves their cash on hand while fully consolidating their control. And that brings us to part 5, looking ahead, key risks. Look, despite the incredible momentum, the clever strategic buybacks, and this soaring revenue, we have to pause and ask ourselves, what are the forward-looking risk factors that could potentially derail SiteOne's current trajectory? Nothing goes up forever without a challenge, right?
Well, their SEC filing explicitly outlines several substantial macroeconomic risks. Since they're heavily tied to building and landscaping, cyclicality in residential and commercial construction is a constant threat. I mean, if building slows down, their core business feels that impact immediately. Then there's unpredictable severe weather. Obviously, you can't landscape in a hurricane, which instantly halts their sales in affected regions. On top of that, they cite supply chain disruptions caused by global geopolitical conflicts and tariffs, which can really drive up the cost of goods. Oh, and of course, there's the ever-present pressure of inflation and elevated interest rates on their variable debt.
Additionally, the filing neutrally points out some regulatory and legislative risks. Specifically, it notes potential unanticipated changes in tax provisions resulting from recent legislation, such as the passage of the One Big Beautiful Bill Act. Now, regardless of the politics behind bills like this, as financial detectives, we really only care about the math. Changes to tax codes could directly impact their bottom line, forcing them to scramble and adapt their financial modeling.
So as we wrap up this explainer, the crucial question remains for you to think about. Can SiteOne's strategy of aggressive market acquisition and sheer financial scale safely guide them through these unpredictable macroeconomic risks on the horizon? They've built an absolutely incredible machine here, but the true test of a powerhouse is how it operates when the weather turns bad. Let me know what you think, and thanks for joining me on this deep dive.